We've been talking about how the intelligence community and the national security community can learn from capital markets, can read signals from capital markets. But the reverse is true. There's a lot that capital markets can learn from the intelligence community about how you analyze things and look over the horizon, as we say, as to what's going to happen in the future. And one of the ways we do this in the intelligence community are what are called indications and warnings, I&W for short. Let me explain what that means. A lot of analysts like to put a stake in the ground and say, here's absolutely what's going to happen. Well, that's impossible. No one knows exactly what's going to happen. No one knows exactly when. No one has a crystal ball. So what you do is you sort of look at the future, use history, complexity theory, and other kinds of analysis, and you come up with several different scenarios, maybe 2 or 3 possible outcomes, and they can be quite different and they can have different implications for investors. But then when some analysts get that far, they say, oh, this one has a 30% probability, this one has a 40% probability, and so forth. But that's incorrect also. The truth is, one of them has a 100% probability, the others are 0. You just don't know which one in advance. So what you do is go back to where you are now, look at these possible scenarios in the future, and say, I'm going to follow a path to get to one of those outcomes. I don't know which path I'm on, I don't know which outcome I'm heading for, but there are indications and warnings, signposts, mileposts along the way. And if I can read the mileposts correctly, I know what path I'm on, and then I know where I'm going before anyone else does, and that's very valuable to investors. These mileposts, as I call them, and these indications and warnings, they're very, very important. They're the key to really seeing the future. I like to say, I live in New York, and if I drive to Boston, all the restaurants are McDonald's. If I drive to Philadelphia, all the restaurants are Burger Kings. Well, if you put me in a car and I didn't know where I was going and I saw Burger King, I would know I wasn't going to Boston. So that's a very simple example how the intermediate signpost can tell you where you're going even before you get there. So what are the indications and warnings? What are the signposts, the 7 signs that investors should be looking for to tell them where the world is heading? The first one is the price of gold. Now, the price of gold fluctuates. It goes up and down. We know it's volatile. We understand that. It's down a little bit since August 2011. It's been coming back a little bit lately. It's certainly volatile. But the price of gold is sort of like the thermometer you put in a patient's mouth. You put the thermometer in the patient's mouth to see what their temperature is. The thermometer isn't the illness. The thermometer tells you if the patient is ill. Same thing with the price of gold. The way I think about it, gold doesn't really change in value. An ounce of gold is an ounce of gold. It was an ounce of gold 5,000 years ago. It'll be an ounce of gold 1,000 years from now. When people say the price of gold is going up and down, the way I think about it is no, gold's a constant store of value. What's fluctuating is the dollar. In other words, a higher dollar price of gold, if you think of gold as constant, what it really means is the dollar is going down. The dollar is beginning to collapse. So when you see the price of gold going up, don't think of it as a rally in commodities markets. Think of it as a declining dollar. That's an early warning that the dollar collapse is beginning. The second one is related to the first, is central bank gold acquisition. Now, since the mid-1970s, central banks have disparaged gold and says it forms no role in the monetary system. But the paper money regime is really just an experiment. It's not that old. It's only been around for a little over 40 years. Gold is a long-standing store of value. It may come back to form that role again. Well, how would you know if gold is coming back to center stage in the international monetary system? Don't listen to what the central banks say, watch what they do. And when you see them acquiring gold, you know that gold's day is coming, that gold is about to return. Well, as I mentioned, we've seen central banks selling gold since the 1990s, but in the last few years, since 2009, they've been buying gold. China's the big buyer, but there are others. Russia's buying gold. Argentina, believe it or not, Kazakhstan, the Philippines, Vietnam, Mexico, go around the world. All these countries are buying gold. And the U.S. is not buying gold, but we're not selling any. We're hanging on to ours. Europe is hanging on to theirs. So the big holders of gold are holding on to it. They're not selling anymore. The smaller holders are buying more. Watch those numbers. They are available. They come out quarterly, and as you see central banks increasing their holdings of gold, that's another sign that the dollar collapse is coming and the kinds of adverse outcomes we've been speaking about are right around the corner. The third sign, IMF governance reform. This is a little bit of a geeky subject, but the IMF is like any other organization. You have votes. Of course, they don't call them votes. They call them quotas. It's just everything in the IMF is its own language, so to speak. But there's an interesting governance structure. A lot of this was set up right after World War II in 1944, but the world has changed a lot since then, obviously. And certain economies have grown much larger than their share of IMF votes. China's a good example. China's about 10% of global GDP, but they only have about, actually less than 5% of the votes in the IMF. So clearly they're underweighted. China says we need more votes to reflect our size of our economy relative to world GDP. And the US has 16% approximately of the votes. That's a very interesting number because in IMF governance, it takes an 85% vote to make an important change. Well, if you have 16% yourself, which the US does, then all the other countries in the world together can only get to 84% because, of course, it adds up to 100. So as long as you need 85%, we have 16%, that means the US can veto any important governance change in the IMF. But what if our share were reduced below 15%? So suddenly the other countries could outvote us. What if China got more votes? And oh, by the way, the votes have to add up to 100%, obviously. So if China's going to get more, somebody else has to get less. And it's not just the US potentially, it's actually countries like Belgium, Netherlands, and others. So there's a big fight going on behind the scenes. Right now, not much has happened. This is pending. Certainly Christine Lagarde, the head of the IMF, wants to push this through, but the US is using its veto power to stand in the way. But if that dam breaks, if that actually goes forward, and you see China getting more votes, European countries getting less, and the US losing its veto power, this is a big breakthrough in terms of these SDRs coming along to replace the dollar, which will be highly inflationary. So IMF governance reform is the third thing to watch. The fourth is the failure of regulatory reform. You know, in 2008, what did we hear about? Too big to fail, too big to fail. The banks had to be bailed out because they were too big to fail. Well, guess what? Since 2008, the biggest banks in the United States are bigger than they were at the time. Those 5 biggest banks own a larger percentage of all the assets in the U.S. banking system, and their off-balance sheet, their derivatives, are much bigger. So everything that was too big to fail in 2008 is bigger and more dangerous and riskier today. So regulatory reform has failed. Now, there's still some efforts pending in Congress to rein in the banks, maybe bring back Glass-Steagall, separate commercial banking from investment banking, increase capital, reduce leverage, ban derivatives. These would all be very good things, but they're not happening yet. Watch it. If it happens, that'll be a positive development. But the banks own this town. The banks own Washington. And as a result, if this failure of regulatory reform, if this continues, you can expect the system to collapse because the banks are getting bigger and bigger. That means more risky, more dangerous. The fifth warning sign are system crashes. When I say systems, I'm talking about the stock exchanges and the payment systems that really are the plumbing of the international monetary system. This is another layer of complexity. We've talked about complexity in capital markets, and we've spoken about it in terms of the size of the banking system, debt, leverage, derivatives. But there's another layer of complexity, which is the actual computers, the fiber optic cable, the servers, the routers, the message traffic, the communication system. That's really the hidden plumbing of the financial system. It's getting shakier and shakier. In 2010, we had the flash crash. The stock market plunged enormously in a very short period of time based on high-frequency trading. All of a sudden, bids were pulled. People who thought they were buyers instantaneously disappeared by automated computers pulling the orders. The system collapsed. It came back, but that was a very scary moment, which has never been fully explained. August 2013, NASDAQ was closed for half a day. We've never had a good explanation of that. Night trading in 2012, their computers went haywire and started flooding the stock exchange with orders that were completely out of control. No one could find the kill switch. Nobody could stop the computers from taking down the exchange, and that ruined the firm. It was ultimately had to be bailed out. So these crashes are more and more frequent. Someday it'll crash and spin out of control. So watch those, watch the tempo of those. The sixth sign is the end of QE and the end possibly of Abenomics in Japan. QE is quantitative easing. That's money printing by the Fed. Abenomics is named after Prime Minister Abe of Japan. That's money printing in Japan. The Bank of Japan and the Federal Reserve are working hand in glove to print money to try to prop up this house of cards or this shell game that's going on. But they're beginning to get cold feet. The central banks are getting nervous. They're saying, you know, we thought it would have worked by now. We thought we could print a couple $1 trillion equivalent and it would solve the problem. But it didn't solve the problem. So we printed $1 trillion more and $1 trillion more. At what point do they get nervous? Start to worry about their own balance sheet. Pull back. So watch that. If they keep printing, you're going to have one kind of collapse, which is that people will lose confidence in paper money. But if they stop printing, you'll have a different deflationary collapse because the money is needed to keep the economy going. There's no good way out. There are bad choices on both sides. If you stop QE, you fall into a deflationary collapse. If you continue QE, you have an inflationary implosion. So there are bad results either way, but you need to watch it to see which way we're going. And finally, sign number 7 is a Chinese collapse. We talked a lot about the collapse of the dollar and the collapse of the U.S. financial system. China's no better. They're a house of cards. We talked about Fed money printing. Believe it or not, the People's Bank of China has printed more money than the Fed. That's right. They're more leveraged, more of a house of cards, more money printing, more bad credit than even the United States of America. So this collapse could start in the United States, but it could just as well start in China. If it starts in China, don't think it's going to be confined to China. You know, I was in Japan in September 2007 when our mortgage collapse in the U.S. just began. You know, the panic was in 2008, but the collapse started in 2007 with the collapse of the mortgage market in the United States. So I was in Japan in 2007 in September, and Japanese stocks were sinking like a stone. They were crashing. And my Japanese friend said, wait a second, we don't understand. We understand that you Americans have a mortgage problem, but why are Japanese stocks going down? And I explained to them that when you're in financial distress, you don't sell what you want, you sell what you can. And those hedge funds in the United States were selling Japanese stocks, which were good assets, to get cash, to meet margin calls on the bad mortgages that they couldn't sell. So that's an example of what the IMF calls spillover effects, or some people call contagion. Financial crisis jumps from one market to another because people sell assets over here to get cash to meet their liabilities over here. As China starts to implode, they might sell treasuries and U.S. stocks to raise cash to pay off angry depositors, and their problem will quickly become our problem. So watch these 7 signs. Any one of them could be the beginning of the collapse of the U.S. financial system.